I've titled my talk here, 5 Forces Driving the Real Estate Market in 2016. So 5 things that we're going to talk about today in terms of 5 forces that are going to affect the real estate market in 2016. And of course, the number one we're probably all very familiar with is the economy. The economy underlies everything that we do in terms of the real estate market and a lot of other areas of the economy. So I guess, you know, without spending too much time and going into too much detail, I want to point out a couple things that probably lay the groundwork for a lot of the things we see on television and in the headlines in terms of the economy and what's going on and what has occurred over the last couple of years. If you look at the broadest measure of the economy, and that's GDP, and we hear about that periodically when the latest data is released, and if you follow this regularly, you know that a lot of the commentators and a lot of the analysts have said, we're just not growing the way we should be. We're not growing as fast as we have. The expectations of growth have just been disappointing on an ongoing basis over the last several years. And so one of the ways to think about that is how do we compare today to where we expected to be? And if you look over the last 50 years or so, we grew at about 3.5% a year. So that's kind of the benchmark that everyone has in mind. It varied from one year to the next, of course, but on average, the green line there is about 3.5% a year. Where we're at now, and you can see over the last few years, since the recession, we've been growing at about 2%, or maybe even a little bit more than 2%. And so that's this very real sense that things aren't going as well as we would like in terms of how fast the economy is growing. Of course, that has implications for a lot of different areas of the economy, including real estate, but a lot of other areas as well in terms of consumer confidence and whether people are feeling good about spending money. So why are we in this situation here where we're just not growing as fast as we have been in the past? And I think one of the differences, and this has been documented by the academics who look into this kind of thing, is coming out of a financial recession, which we did, of course, in 2007, 2008, is a very different type of recovery than your more typical recovery that we have seen many times in the previous 50 years. Coming out of a financial recession, companies and households, they're basically trying to pay down debt. And if you're paying down debt, that means you're not buying new cars and you're not buying real estate. You're spending that income that you do earn on something else. And as important as paying down debt is, that's paying off things that you have used, purchased in the past. It's not creating anything new today by the very fact that you're paying off debt today that you've accumulated over the past few years. So basically, that's one of the reasons that coming out of a financial crisis, things just take much longer to get going again, and we can very easily see that we're growing much more slowly than we have been in the past and much more slowly than we expected as well. The other side of that, and this is a little bit better news, is where we're at in terms of job growth. It took us a long time to get going, but from a national perspective, we lost about 8 million jobs. 6 years later, we'd regained those 8 million jobs, and since then, we've added about another 4 million. So we're ahead of the peak by about 4 million jobs. But it took us 6 years to get there. Now, 6 years is a long time by anyone's measure, and that's one of the reasons that we saw a lot of concern among consumers. Consumers weren't that optimistic, and until very recently weren't really too engaged in spending a lot of money on large ticket items. So that's one of the reasons, just the pessimistic nature of the job market that we've seen over the last few years, and until very recently had been just recovering the jobs that we had lost over the previous recession period. In Denver, a much better picture. Of course, lost 76,000 jobs. That's not good news by anyone's measure. Regained those 76,000 jobs. It only took about 4.5 years. So the recovery was much quicker, and we've added another 125,000 jobs on top of that. So from the perspective of the job market, things are positive, much stronger than we might have anticipated even a couple years ago. We're continuing to add jobs as we go forward here, and the expectation is the job machine will keep churning ahead, assuming there's nothing of a significant surprise that comes out of the blue to derail that. But again, kind of a slow, steady progress in terms of the job picture. So we have a little bit more optimistic view in terms of the economy based on the job picture. Related to that, of course, in terms of these forces that we like to talk about in terms of the economy, is what happens to interest rates. If the economy is weak, of course, we expect interest rates to be low, and we've seen that over the last several years. The interest rates have been very low. But what is the expectation going forward? If you put yourself in the position of someone at the Fed thinking about all of this and what they want to do in terms of interest rates, one of the first things you look at is, what does the inflation picture look like? Do we have any inflation? And basically the answer is not much. And that 2% line that you see highlighted there, that's the target. That's kind of the ideal level of inflation that the Fed likes to see. What's special about the 2% number? Well, there's nothing in particular that comes from, research or theory or anything about 2%. It's just a number that seems to suggest there's some inflation, but not too much, and that's kind of the consensus that the central banks around the world have decided is a healthy level of inflation. Some, but not too much. Where are we at today? We're actually under that. We don't have enough inflation compared to what the policymakers would like to see. So we have a job market that's moving ahead. That's good news, but we don't quite have enough inflation. Why would you say, why don't we have enough inflation? Isn't low inflation good? Well, one of the risks here is, of course, if you have too little inflation, then you get closer and closer to the point where you can actually see prices falling. And that's a very difficult spiral to stop. So we don't want to even get close to that, and that's part of the reason why this low but steady inflation rate around 2% is what policymakers like to see. But if you dig down into that a little bit more, so instead of just looking at one number, the headline number, what does inflation look like when you look at a few of the components? And as we all know, rent has been rising, and not just rising at 2 or 3%, but actually rising at a faster and faster pace. Again, these are national numbers, so of course, in different areas of the country, it's going to vary quite a bit. But as you can see, the red line there, rent is actually accelerating. Whereas everything else that makes up that 2% number that we're focused on is actually increasing at only about 1%. So the question is, what happens when that other than shelter, everything else, starts to pick up? Maybe the inflation rate in some of those other areas of manufactured goods and clothing and food and things like that start to pick up a little bit. Then we may be getting closer and closer to that 2% level that policymakers are aiming toward, and hopefully not getting too much above that 2% level, so that policymakers have to kind of step on the brakes here because they fear inflation is getting out of control. But the 2% number is kind of what to keep in mind when you hear the next inflation numbers being released. So what does that mean for Fed policy? So the Federal Reserve sets short-term interest rates, and you can see that has been at virtually zero since 2009. So one of the longest periods of virtually zero short-term interest rates we've seen in many decades. But at the same time, the mortgage rate is right around 4%. And we all know the mortgage rates have been very favorable for the last several years. So what is the Fed thinking about? They're thinking about, when do we raise interest rates next? We have relatively solid employment gains, inflation right around that 2% mark. So when do we reverse course from that zero interest rate policy? And if you watch the business press on cable news and things like that, it's become very much a sport to guess when, in fact, the Fed is going to raise rates. We thought at the end of September, everybody was certain that their meeting at the end of September, they would raise rates. Well, they decided not to. Now everyone is certain that at the end of December, their next meeting, they will raise rates again. And the consensus is 60-some-odd% of economists and analysts think that's going to be the case. There is even some who think that maybe it'll be into 2016. After all, things are moving along okay, but there's no sign that inflation is getting out of control here. So what happens when they actually do raise rates, whether it's in December or early 2016? Probably not much. Raise rates maybe 0.25% this time. At their next meeting later in 2016, if they start in December, maybe another 0.25%. But as you can see here, the mortgage rate, it's not really that strongly correlated with the short-term interest rates. A lot of things affect mortgage rates beyond what the Fed policy is. So I think it's wise not to get too wound up in kind of this horse race discussion that you hear in the press about when they're going to raise rates next, and boy, isn't the ramification of that going to be, something we have to really be aware of, and all kinds of bad things might happen if we start raising interest rates too soon. As you can see, at least from the mortgage market, there's not a strong connection there. So while it's important to be aware of what the Fed policymakers are planning to do, I think we need to kind of dial back some of the rhetoric we see on television and in the news media in terms of the ramifications of starting that process of raising rates, whether it's December or sometime early in 2016. The third force in the market, and we're all familiar with this, I'm sure, is inventory. If there's one picture that probably describes what we've experienced in the housing market the last several years, this is probably it. This is simply the number of homes on the market for sale at the national level. In 2007, 2008, we had almost 4 million homes on the market. The highest level we'd seen, at least since the statistics that NAR's collected, 4 million homes on the market. And that was at the point where we had month supply, 10, 12, 14 month supply, and a lot higher in a lot of other areas as well. But now, since about 2013, we're about 2 million, and it's been bouncing around the 2 million level now for several years. So by any measure, a low level of inventory. Now, if you would have asked me, say in 2010, when we had maybe 3.5 to 4 million homes on the market, how quickly that inventory picture would turn, would we ever get to 2 million homes on the market on a regular basis this quickly? I'd have said probably not. And I think maybe a number of us were caught by surprise in terms of how quickly the inventory situation tightened up. And it's been relatively tight, as you can see there. Highlight the last few years is what I've described as low inventory. And it seems to be bouncing around without much change right at that 2 million mark. And one of the things is that in terms of existing home sales, if you look at that line hard, the red line there, and stare at it a little bit, you can see existing home sales have kind of bounced around pretty flat over that same period of time that we've had this low inventory. So much of the information we have and the analysis we've done suggests that actually the inventory situation is holding back home sales to a large degree. And had there been more homes available for sale on the market, something above that 2 million level that we've been stuck at now for the last few years, we might have seen more home sales overall. So the level of inventory has actually been a pretty significant constraint on the number of sales that we could have. And at the very last few data points, you can see that existing home sales numbers have increased a little bit, but that's hard to tell if that's the start of a longer-term change in the level of home sales, or if it's just a little blip there over the last few months. But no doubt over the last short period of time, the inventory level has been a key factor in holding back existing home sales. And when you look at pending sales, pending home sales also have taken a pause as well here. You can see the last few months, they've actually declined. So again, the inventory situation is the key factor holding back the housing market at this point. And in fact, one of the things we've seen is not only a very low median level of number of days on the market, it's ticked up a little bit, but it's still been very low by historical standards. So as we all know, well-priced homes that go on the market don't stay on the market very long. And so we see that this is the national level certainly, and of course it varies a lot across different communities in terms of the number of days on the market and the level of inventory. What do things look like in Denver? Again, this is information from your association in terms of data through September, year-to-date through September, and not surprising, the active listings on a year-to-date basis in 2015 are about where they were in 2014, but that still is at a very low level, relatively low level, certainly compared to the last several years. And the days on the market were roughly 23 or 24 on a year-to-date basis. So the story is very much the same in the local market. even more so, though, than the national numbers would suggest. So in terms of the month's supply, another way of looking at the inventory situation is simply how many months of inventory are there on the market relative to how long it would take to sell that inventory at the current sales pace. So this is just another look at the low level of inventory, and you can see the level is really reflecting a balanced market. It's right around 6 months. Nationally, we're a little under that. So the question is, what happens next spring? Normally, we see in the fall and winter months an increase in the number of homes for sale in anticipation to some degree in the spring selling season, but so far we're not seeing that. So the suggestion, or what this data suggests to me, is that the spring selling season, we're going to see just as tight an inventory situation as we have in the last several months. There's really no relief in sight in the immediate future in terms of the inventory level, simply because we're at a low level and there's no indication that that's going to change anytime soon in terms of number of homes that are available for sale, both at the national level and, of course, very much a similar case here in the Denver area. What does that mean for prices? Not surprisingly, prices have increased. And just to give you some sense of where we have come and where we're at in terms of prices, if you look at, remember the chart I had a few minutes ago where we had about 4 million homes for sale back in kind of the depths of the economic recession, home prices were falling at about a 15% rate when we had something over a 10-month supply. Quick recovery as the inventory levels declined, and in that period over the last few years where we've been kind of bouncing around in the 4.5 to 5.5 month inventory range, home prices have been increasing by about 5%. So again, if you kind of connect a few of the dots here, we don't anticipate any significant change in the inventory situation, and home prices will then probably continue to rise in the 4-5% neighborhood nationally in 2016 as well. So it's very much the same picture going forward, we anticipate, in terms of early 2016 at least, compared to what we've seen over the last several months as well. If we look a little more closely at some Denver information, so this is the change in sales, again, year-to-date September 2014 compared to year-to-date September 2015 at various price ranges. So we have the red bars single family, the gray bars condos. So for example, in the 0 to 199,999 price category, we saw something approaching a 60% decline in single family sales year-to-date 14 compared to year-to-date 15. About a 40% decline in terms of condos in that same price range. And very similar story in the next price category up to $200,000. So collectively, those two price categories account for about 17% of sales and less than 1 month of inventory in those categories. So nationally, we're looking at 3, 4, 5 months, depending on exactly where you're at. Locally, in this price category, less than 1 month of inventory. So that's part of the reason we see those negative numbers in terms of sales. There just aren't houses out there to be purchased. And so that's holding down sales. Look at the next group. So this is the two price categories between 200 and 400. Not quite so negative in terms of sales over the last 2 years. Accounts for about half of all sales. But yet again, we have less than 1 month of inventory in those two price categories as well. So again, extremely tight inventory conditions, and we can see the result of that in terms of sales. And the top group of price categories from 400,000 all the way up, again, sales gains over the last year, but that accounts for about 30% of the market and 3.5 months of inventory. So in the real, if you will, sweet spot in the market, accounting for about 60% of sales or so, you can see that, in fact, the number of sales has certainly been held back by the low amount of inventory available for sale. Regardless of the price category, it's very much a similar story all the way up to about $400,000. So what does that mean, kind of stepping back and looking at the big picture here? So the overall sales on a year-to-date basis through September from 2011 through 2015, basically plateaued in 2013, 14, and 15 at this point. Again, the inventory being the primary driver of that level of sales, or the extent to which sales have flattened out. But at the same time, the average prices keep rising. And we can see that in any number of ways across various price categories, across various areas of the state. But overall, prices continue to rise. The average price now something over $350 for the Denver metro area. So how does all of this compare to what we're seeing nationally? I mean, we have a lot of national numbers that we talk about, but what's the comparison between the Denver, Colorado, and U.S. in terms of price growth? And basically the headline there is that locally home prices are growing about twice as fast as they are at the U.S. level. And again, all of these factors are coming together to be reflected in price growth. Home prices nationally about 5% and roughly 10% in both Denver and Colorado at this point. So what's some of the ways that we could alleviate the inventory situation? That seems to be the key reason that we're seeing limits on sales, rising prices, and actual sales declines in some price categories. Well, there's a couple ways we could think about this. One is, what is the distressed and foreclosures and short sales, the distressed segment of the market look like? And in fact, that's pretty much gone away. You can see the share of existing home sales that are distressed, about 30% at one point in 2010 and 2011. Now we're down to less than 10%. So basically the distressed properties, they're pretty much out of the system at this point nationally. There really aren't that many more distressed properties to come onto the market. So the discussion that we had a couple years ago about this huge influx of distressed properties coming on the market, driving down prices, some of the fears that engendered, that just didn't come to play. So distressed sales are down, less than 10% of existing home sales. What about the pipeline of sales, potential sales in terms of foreclosures, or those mortgages that are at least 90 days past due? At the peak, about 4.3 million mortgages were past due or in foreclosure in 2010 in the U.S. We're down to about 1.6 million, so we've cut that by about 2/3. In Colorado, very similar story. At the peak in 2010, about 59,000 mortgages were 90 days past due or in foreclosure. Now we're down to about 14. So that's probably not a viable source of future inventory either, simply because that's kind of worked its way through the system at this point, and less than 2% of mortgages, equivalent of the 14,000, are either 90 days past due or in foreclosure. So we're getting very much, very close to where we had been before the recession. So again, that's not an outlet for changing the inventory situation. And to give you some sense of where we're at in terms of the third potential source of inventory, housing starts, we're not building nearly enough homes nationally. On average, we built about 1.7 million homes each year. Again, this is total, both single family and multifamily. And this is before the recession, so this is kind of the base period, if you will. And you can see we've got a tremendous gap there at this point. Now we're building maybe just over 1 million homes, plus the accumulation of all the homes we didn't build in each of those years as well. So we're not building nearly enough homes. So the one way that the inventory situation could be alleviated very quickly would be simply to build more homes. And you can see something very similar to that in Colorado. Numbers are a little bit different, but very much the same pattern. Building about 45,000 homes a year statewide from 97 to 2006, and right now right at about 30,000 homes. So again, not only the gap that you see in the current period, but that accumulated gap for each of those years that we weren't building that 45,000 homes per year. So that's one of the factors that I think is about the only way that we can relieve the inventory situation is if we start building more homes. And what it takes to build more homes, that's, a lot of factors go into that in terms of what builders are seeing, their ability to get financing and so on and so forth. But whatever the factors are, it's pretty clear we're not building enough homes, both at the national level, but that's very consistent with what we're seeing at the local level as well. So Inventory is probably the key driver going forward. We just spent several minutes talking about the inventory situation. So what's next? Of course, related to that, if we have rising home prices, is affordability. And if you recall the chart I showed for the Denver area, prices continuing their march up, something over $350,000 according to the latest data. Home prices nationally rising, 5% or more a year. Some areas rising much more quickly than that across different areas of the country. So at what point does affordability become a challenge for especially today's renters as they look to be homeowners? So here's some data that we've collected based on a survey that we do every year. And this is from the survey of home buyers and sellers. So this is an annual survey that we do of recent home buyers and sellers from the previous 12-month period. And we ask a number of questions about the home buying and selling process that they've experienced. So we not only collect demographics of home buyers and sellers, age and income and so forth, but we ask about their experience working with a realtor, financing, how they found a home, and we ask a number of questions of sellers as well. So if we focused on the left side here, one of the questions we ask is, what was the most challenging thing about your home purchase, or being prepared for your home purchase? And for, you can see the red bar on the left-hand side, first-time buyers, 25% said it was saving for a down payment was the most difficult hurdle that they faced. And the 25% in 2015 is higher than it was in 2014 and so forth. In 2010, it was about 15% of first-time buyers said that was the most difficult challenge. So we've added 10 percentage points among first-time buyers who have said that saving for a down payment is the most difficult task in terms of the purchase process. A little less for repeat buyers, the gray bars there in that chart on the left-hand side. So if saving for a down payment is the most difficult task, and it's not hard to imagine why. We have rising rents, so that means a bigger share of potential first-time buyers' income is going toward rent rather than saving for a down payment. Underwriting standards, as we all know, are tighter than they have been, and in most cases require a larger down payment. So it's not hard to imagine why saving for a down payment has become increasingly difficult, especially for first-time buyers. But even over and above that, one of the questions we asked is, what expenses delayed your ability to save for a down payment? So in addition to rent, we ask about different types of debt. Most of us have debt of one sort or another, and if you're a first-time buyer, potential first-time buyer, you may have, for example, quite a bit of student loan debt. And you can see that for first-time buyers who found it difficult to save for a down payment, about 60% of those first-time buyers said it was student loan debt that was the primary headwind in terms of their ability to save for a down payment. For first-time buyers, also a car loan, credit card debt. So these are not unusual types of debt you would imagine someone in their 20s and 30s to have. Student loan debt, that first car, maybe some credit card debt. But cumulatively, those are pretty significant in terms of holding back the ability of many first-time buyers, not all of them, but many, to purchase a home. And one thing you have to keep in mind here, given the nature of the folks we surveyed, these are people who have successfully completed the purchase of a home. This doesn't say anything about potential first-time buyers who were unable to purchase a home because of debt or any of these other hurdles, just not being able to save up for the down payment. So even among those first-time buyers who successfully bought a home, this is the picture that they're painting for us in terms of the hurdles that they're facing when buying a home. So we just released the 2015 data a couple days ago, and you can see it there, 25% said saving for a down payment was one of the most difficult tasks. Hopefully we're reaching a plateau there. No doubt there's always going to be some difficulties, especially as a first-time buyer, in terms of hurdles you face, and down payment has traditionally been one of the top hurdles that any first-time buyer faces, but certainly hope that that line plateaus and we don't go much, if any, beyond 25% in the next several years, simply because that'll be one of the factors, of course, holding back the market if that becomes even more significant than it is already. Another survey that we conduct, this is of current homeowners and current renters. So So we're not asking questions of people who just recently bought a home. We're asking basically a representative group of people who are both homeowners and renters. So this is a nationally representative survey we started to do. And so given all of the hurdles that renters face, one of the natural questions is, maybe millennials, especially in the 20s and 30s, who make up the bulk of the first-time buyers, have just given up on home ownership altogether. So the question is, have they? So we asked among renters, current renters, do you ever want to own a home? Maybe it won't be next year, maybe it won't be 2 years from now, but do you ever want to own a home? And 83% said yes. So that's an encouraging number that still 8 in 10 renters would like to own a home, even if they're not able to do it necessarily today, next year, or even in the next couple of years. Among those who said no, that tends to be based on the demographic side. There are some renters in their 50s and 60s who just don't ever want to own a home, so that's reflected there in many of the no answers. But if you look at the younger group, some data I don't have on this slide, but if you look at the younger group, 20s and 30s, that number is even higher than 83%. So it's very encouraging when you have the largest group of potential first-time buyers who are currently renters saying, we still want to be renters, although we don't necessarily know how soon that's going to happen. We want to be a homeowner at some point. So if you're a renter currently, what's holding you back? Why don't you own a home? If it's a strong desire that you have, what's holding you back? And here we touch on the affordability issue. Now, no doubt for every first-time buyer, affordability is a concern to some degree. It's the hardest rung on the ladder to achieve in terms of home ownership, of course, is buying your first home. But 42% said, I can't afford a home right now. And for those various reasons we talked about earlier, even among the successful home buyers, saving for a down payment and those hurdles to saving for that down payment are a big factor for a number of first-time buyers. Life circumstances, for some people, this just isn't the right time to buy a home for a lot of non-financial reasons. Need the flexibility of owning versus renting. I'm just not settled in my career or where I'm going to live geographically, so I need the flexibility of renting. And for some people, they just don't want the responsibility of owning. Now, it's only less than 1 in 10, but there are some renters out there who just, I don't want any of that type of responsibility. Related to that, though, is we asked among renters whether or not you are going to buy a home next year or whatever your plans are, given your financial situation. Do you think you could qualify for a mortgage, and how difficult do you think it would be? And 6 in 10 think it would be difficult to qualify for a mortgage among today's renters. Now, whether or not they're assessing the difficulty correctly or not, maybe they have an overly pessimistic view of how difficult it is to qualify for a mortgage, or maybe they're correct. But regardless, there's a significant number of renters who think it would be difficult to qualify for a mortgage. So for some, that might be also something that's holding them back, just not even trying to buy a home because in their view, they don't think they could qualify for a mortgage and just don't want to start the process. So affordability is certainly one of the factors we have to continue to watch. There's some encouraging news here in terms of the views of renters. But what about first-time buyers, even over and above renters? So if we look at kind of the big picture here in terms of the demographics of home ownership, much like the US, if this was a US chart versus Colorado, it would be very similar. But this is data for Colorado. In 2005, the home ownership rate was just under 70%. In 2014, it's the latest data that's available, it had dropped a little bit. But if you break that apart by age group, 34 and younger, 35 to 44, and so on and so forth, you can see where the biggest drop in home ownership has been, and that's been those 34 and younger. So that goes right to the heart of the discussion about first-time buyers, because the vast majority of first-time buyers are in that age group. So not only are they a little skeptical, they've also been hardest hit in terms of their ability to sustain home ownership going forward. So first-time home buyers have been hit hardest by home ownership. Here's the national numbers in terms of the first-time home buyer share. We like to see about 40%. That's what it had been traditionally. This is some monthly data that we collect. We're right now at 30%. So this bears out kind of everything we've been discussing here in terms of first-time home buyers. But at the same time, we also ask both current owners and renters whether or not they think buying a home is a good financial decision. So you can imagine a renter who thinks they may be qualified, they could get a mortgage, they've got a sufficient down payment, but then the question comes to mind, is this a good financial decision to buy a home? And among all consumers, so both owners and renters, 84% think buying a home is a good financial decision. And not only do they think that, if you break that apart a little bit more, 2/3 of that group, 64%, or actually 64% of that 84, strongly agree. So they're very certain in their minds that buying a home is a good financial decision. And if you look at this only among renters, it drops a little bit, but still even among renters, 76% or 3/4 think buying a home is a good financial decision. So I think there's a couple strands here that are coming together. One is the desire to be a homeowner among those who are not currently homeowners, and the ability to become a homeowner. And at this point, this data suggests to me it's not the desire that's lacking, it's the hurdles that are in place for current renters and potential first-time buyers that are limiting their ability to go forward and purchase a home.